Welcome to the Australian property market. We're seeing cap rates stepping out. Consensus across the market since market peak is to see about 70 to 100 basis points movement. Now at the shoulders of the market, we're seeing much more than that, peaking at around 250 basis points, and the sharper end of the market, that's down to about 30. Today we're looking at what we can expect from the June 2024 valuation round. It ain't all beer and skittles in the commercial office market at the moment. We've collected a couple of hundred data points, crunched it all up and made some maps, used a bit of AI, and we're here to tell you what we learned, help you de-risk the June 2024 valuation round. Valuation is as much an art as it is a sweet science. Heck, sometimes it's just fortune telling. At the end of the day, the reasons for the decreased valuations are well known. Work from home, Jerome Powell's money printer, inflation, and the Reserve Bank of Australia's 2021 promise to leave interest rates low for another 3 years. Yeah, right. This somewhat unheralded increase in the risk-free rate has in turn driven up the cost of debt and equity for landlords, in some instances threatening to push it higher than the cap rates on their existing buildings, which would completely invert the business model of a number of quality funds. The built-up cap rate method is a powerful tool for understanding why local money is locked out of the office market, with the primary input being the risk-free rate that the Reserve Bank's moved out by 425 basis points. Local money just can't compete with international buyers from Singapore, Hong Kong and Japan who are buying back into the market at a 70 to 100 basis point expansion in cap rates. Next we move to market sales comparisons, which at the moment are rare as hen's teeth. It's one of the big underlying risks of the asset class, the lack of liquidity during a market downturn. It's important to understand that this cap rate expansion is not uniform across the board. When we look at the expansion that's already happened and break it down into asset classes, geographies, and other subsectors, there are certain patterns that definitely arise. And we then apply those patterns back through the algorithm to the existing market. So what does this mean going forward? I know you haven't listened this long for me to sit on the fence, so please excuse me while I make a couple of disclaimers. Firstly, while backtesting is massively important, it does not guarantee future returns. Secondly, none of this should be construed as financial advice. Heck, you're listening to someone who thought Bradbury didn't have an icicles chance. You could watch that all day, couldn't you? So, back to the task at hand. Our guidance for the June 2024 valuation round is to see a further 40 to 70 basis points of movement, with us being sheltered from the bulk of the RBA movements by the cheap international money. We anticipate the bulk of funds that we track will ride this out quite easily, with potentially a couple of fringe syndicates having to renegotiate their banking covenants. We will see what the Reserve Bank does for the rest of the year, and hopefully we get to dance a slightly different dance come December. Well, that's it for another day. Thank you very much for tuning in. If you'd be interested in collaborating and looking at the data deeper, please feel free to reach out. There's also links in the bio to our other research that we've been putting out recently. Thank you very much. Goodbye.